Hello, everyone, and welcome to Finance Reporting and Manage. My name is Renee Bergstresser, and I'm a software training consultant with the ConnectWise education team. In this session, really, my goal is to help you find possibly one report or maybe just one metric that you can start using as a way either to have a diagnostic tool for your financial health in some area, as a training opportunity for your team so they can become more effective at helping you drive accurate finance reporting, or as just a way to start setting measurable goals in the product that you use day in and day out. So that's really the intent of this overarching finance reporting session. To handle this topic, of course, finance is a pretty broad topic. We broke it down into 4 different areas of manage where we're going to be looking at profitability and other finance metrics. The first being labor, so time entries. This is really going to be honing in on the importance of tracking all time to see true profitability and, of course, ensuring accurate information for our other reports later on. We'll also get into agreements, which can help us determine which contracts are most profitable for us, or contracts where we might have some improper practices that are leading to too much non-billable time or something like that. We also will take a look at projects, which the project section, a lot of it's about timely billing and also anticipating accurate billing. So setting up appropriate estimates for the time and cost of different project work. And then lastly, last but not least, we're going to look at company profitability. So what can we gather from finding out which companies are most profitable and which are least profitable to our organization? Now, throughout this presentation, please feel free to use the questions pod to ask any questions about the content or answer any prompts, any questions that I come up with, just to see kind of how the room's feeling or what you're doing right now. So please feel free to use that. Our first section we'll look at is labor. Now, as we get into the labor topic, there are a couple questions we wanted you to consider going through this. How billable is your service team? Do you know roughly what percentage you target for their billable percentage, how much time you anticipate is going to be no charge or no cost to the client? Also, is your fixed fee work profitable? When we set up fixed fee work, it can seem like kind of a gamble because we're setting a price and we're saying we'll invoice you for this price or we'll bill you this amount no matter how much time it takes for our team to complete the work. Now, this can be very profitable or not so profitable. It depends on the amount of time your team spends on it. So knowing whether or not your fixed fee work is profitable or not is really important to determine whether or not you should continue to offer fixed fee work. If you need to increase rates, set expectations better, that sort of thing. Also, how much time are we spending on contract clients? We can run into a situation with agreements where we become so focused on that monthly recurring revenue and seeing those numbers that we might forget the work that goes into maintaining those contracts. Are we spending too much time? Are we entering too many time entries on agreement contracts and making them much less profitable than they should be? We'll also get into one of the other sides of that later, which is, are our customers using our contracts? Are they getting value out of them? And then lastly, which technicians at your organization are the most profitable? Do you know based on how much they cost for you to employ them and how many billable time entries they get through in a day? And on the other side, which technicians are least profitable? This might be really more of a training opportunity because what you might find is that the answers you see in managed reporting are not what you expect, which could mean that your team members are very profitable but not entering time correctly, which can actually lead to them being not so profitable because we can't bill accurately when time isn't entered properly. So there's a lot that we can gain from this, but really we're going to dig into some reports that help us figure out how much our technicians' time costs, and then we can determine how profitable they are and where we can be more effective. So the first thing we have to do before we get into any conversations about profitability or gross margins or how much we should be charging for service, it's essential that we can see how much it costs us, the time that we enter, how much that costs our organization. And the best way to do that, or the simplest way to do that, is actually from each individual member's hourly cost. Now, this hourly cost is driven by what we pay them to be here per hour. Now, you could always start off with their hourly rate in this field. That might be something if you're not ready to invest in more, spending a little bit more time on finding the most precise number here, you could always select in or enter in their hourly rate. However, you might start to find that for any employees that are salaried, that's not a very accurate number. There's overhead to be considered, there are benefits, there's a lot more that goes in to having these technicians available than simply just their hourly rate. So to do this, we can actually, there are other ways to find more accurate calculations. One being we have a fully burdened cost calculator on the university. Now, what I will say just before I move on to that cost calculator, I wanted to call out that this field sometimes brings up a little bit of anxiety for team members. They don't want to fill this field out because they're afraid that the wrong people will access this members screen and be able to see what someone else is as estimate being paid. Well, we actually have a new security role that, or a line item in our security roles matrix that was added a couple versions back in Manage that allows you to lock down this individual field. So if you do want to use this field, but you've been a little bit nervous to, just because you don't want that information to be visible, you can lock down this field so that only certain team members have access to see the number entered here when they're on the member screen. So just keep that in mind if that's been something that's held you back in the past. To get the most accurate number for that field, the most accurate reporting so you can make the best decisions, you'd want to use the fully burdened cost calculator because that gets into so much more than hourly rate and it'll give you that more accurate number. Now, this is our fully burdened cost calculator for the United States. We also have separate ones for Europe and Australia on our university. And this is not just United States, I'm sorry, this is North America. Then we have Europe and Australia as well. So definitely check out our documentation if you're looking to calculate this number accurately. Once you have these numbers, if you have certain team members that are in very similar roles or paid the same amount, you can assign those numbers to them en masse, or you can go into each individual member screen and enter that in. Once you have that, every hour they enter into the system, in addition to billing the customer based on the work type and work role that's assigned to that time entry, it's also going to log the cost per hour based on what they're paid. Now, of course, that cost is not translated to the customer. It's not going to show up on invoices or anywhere else, but it will appear in your reporting because things like the financial dashboard will pick up on the cost of the labor and use that to calculate accurate gross margins. So within our financial dashboard, we'll reference this one screen within the finance module multiple times in this presentation. Or I'll reference this dashboard multiple times in the presentation. And that's because we don't just have information on labor, we can see agreements and project profitability as well. But as our first introduction to financial dashboard, I wanted to call out two of the most important fields on here, in my opinion, when we're looking at service. So we're down here in the service section of the financial dashboard, and just a little over to the right, we can see our gross margin, which our gross margin, it takes our revenue and deducts our cost to show what are we really working with? What are we really earning from this labor? And it gives us a percentage. Now you might have, I'm curious to know if anyone on this call has a target percentage for services gross margin. What do you aim for? Because if you do, I'd be curious to see how it lines up with what we've been told. So if you have one, go ahead and throw that into the chat. Thank you, someone already entered in 45%. That tracks really well with what we've seen. Curious to see any different numbers, 40%, 50. Awesome. Well, thank you so much for volunteering that information. So far, we have anywhere from 40 to 50% is what you're targeting for a gross margin on services. And that is pretty typical. And a big reason why that number might seem so large is because it's really difficult to achieve significant gross margins for hardware. So labor is really where you can essentially make your money, and then your hardware, you might have to be a little bit more competitively priced. But once we have a target gross margin, the best thing about just having a target, anywhere, we have 40 to 50, I think what I had heard was anything from 45 to 55%. Once you have that target, you can now really easily look through your financial dashboard and pick out items that don't meet that goal. And one thing to keep in mind is sometimes when we see a gross margin that's much higher than that 50, 55% range, it actually means that we are not entering time properly. So that can be kind of problematic. And if we see one that's significantly lower than that amount, it means that we're either not charging enough or we're giving away too much time. So both too high and too low for gross margin can be a really great indicator that we need to focus on this area. But anything in that mid-range is probably in a good place. Now, in addition to gross margin, we also have a metric here that I love, which is effective rate. Now, effective rate can be a little bit confusing because what it does is it takes the price per hour and divides it by the number of hours billable and non-billable. And really what that means is that we're looking at the total amount invoiced. So I guess the simpler way to say that is if you bill $200 per hour and your technician were to enter 2 hours, one was billable and one was non-billable, their effective rate is not that $200 per hour billed, it's $100 because you had to divide the total invoiced amount, 200, from that one billable entry by the 2 total hours entered. So this is a great way to indicate, well, we may know that we bill at 200, but are we really getting an effective rate of $200 from these colleagues? It's costing us, in this case, it was $21.20 per hour of their time entered, and their effective rate ended up being 133. So that can be a great way to indicate that, or a great place to look to see if maybe we're giving away too much time. Why are we entering so much time on these contracts? Why are they listed as non-billable or no charge? Because that can drive down our effective rates. Something to also keep in mind when you're looking at the financial dashboard, I think one item that can be a little bit frustrating when you look at this for the first time is you might not see data that you like. You might see your gross margin is entirely too low, or it looks very suspiciously high. You might see an effective rate that doesn't really make sense. Well, part of that could be if your team's not entering time properly, you won't have that cost to calculate off of. But also something to keep in mind is that revenue only displays after it's been invoiced. Cost here displays immediately. So if you have an invoice for time for this month, for example, don't expect to see the most accurate numbers. Wait until that invoicing is complete, and then you'll actually see invoiced revenue versus cost. So something to keep in mind. Now, if we want to drill down into that a little bit further, if we're looking at this as maybe not just tracking specific metrics, which gross margin and effective rate are excellent metrics, but maybe we're looking at this as a coaching opportunity. If these numbers don't seem right, but we don't think we're getting 0% gross margin, well, that's when we can start pulling up things like the employee time billing report. Here we can look on a per member basis and see what their effective rates are. This can be a great way to kind of go down the line and see if there are members that seem to be billing at the appropriate amount versus members whose effective rates seem significantly lower than what we charge per hour. Those might be the team members that are submitting too many $0 entries. And likely what that is, well, I shouldn't say likely, but sometimes what we see is we'll see a team member who's maybe a little bit newer or a little bit less confident in the services they're providing. So they might enter in 4 hours thinking, well, I really should have done this in an hour. So they mark 3 as non-billable, which we obviously want to avoid because that's a lot of their time and their effort that's not being billed to the customer. This is also a great place to see through this report. I won't spend too much time on this, but we can see adjustments, which if you've ever made a line item adjustment on an invoice, just entering into that field minus $60, etc., we can indicate whether or not that should be counted against the engineer and their time or against the internal company. So that's another way to change what's listed as their percentages and their effective rate here. One more report that looks at the member that I actually like a little bit better than the employee time billing report. It's invoiced hours by member. What I really like about this report is that it shows the member hourly cost, and it kind of does a better job, I think, of breaking down where that time was entered, how that time was entered, and then you can actually see billable versus non-billable entries here as well. So if you can, I know this is probably a little bit small on your screen, but if you can see, we have this whole section that has billable, and then right here, non-billable. Any item in that non-billable section we'll likely want to take a closer look at, because once again, that's what's going to drive down their effective rate, and it's going to lead to less amount that we can invoice. So this might be the best place where if you're thinking, who are my most profitable technicians, who are my least profitable technicians, this is just one more area where we can spot out why and determine whether or not it's a workplace effectiveness issue or a training need, or possibly they're just not entering time the way they should be. Okay, so a question actually just came through about the financial dashboard with long-term projects. Okay, so when we get into the project section, I'm going to make a note to come back to that, because we actually do have at the very top of the financial dashboard, we have the ability to look at specific time periods. So you can look at the projects section specifically, but you'd want to make sure the time period at the top matched the length of that project if possible. And I'll take a closer look at that because there might be something I'm missing. So Matthew, if you have follow-up questions on that, or if you think I'm missing something, please feel free to continue, add another entry in there, then I'll take a look. But in the meantime, we're going to go and look at agreements, which is one of my personal favorite areas because I find agreements to be one of really just the best ways in Manage to have very consistent billing, very consistent reporting, and it makes and a better relationship with a customer because you have this ongoing contract. You can set standards up in the beginning or up front, and then they can receive a very consistent bill and the service that they need for the next month, for the next year, for the next 3 years. So agreements are one great way to do that. And for a lot of customers who rely on agreements, that monthly recurring revenue from contract customers could be the bulk of their business. It could be one of the most important pieces in their financial reporting. And when it's that important, if it makes up that much of your annual revenue, it's really important to monitor those records and make sure that they're still profitable. And on the other hand, that they meet your customers' needs. So those are the two things we try to balance with agreements. Is it profitable? Are we entering too much time on these for how much we're charging? And also, are they actually using the agreement? Because the only thing worse than a customer using an agreement too much and driving down the profitability is if they don't use it at all. And the next time the next time they need to review their numbers, they're looking to cut costs and they might consider cutting this relationship because they don't see the value in the agreement they're paying for every month. So those are the two things we want to balance when we're looking at agreements. Now we can go onto the financial dashboard for this as well. And if we scroll down, actually, it's a little hard to see in this screenshot, but if you'll notice at the top, the financial dashboard is month to month. So now that I'm thinking about that, now that I'm looking at this, Matthew, there might be a different way that we can pull the numbers that you need because I'm not entirely sure how we would see that long term, just at a glance, but I'll look into that a little bit more later. But within the agreement section, instead of this being broken down by our cost for labor, we're actually looking at this based on the contract types. So contract types or agreement types in Manage, as they're called, these should represent your different service offerings, the different agreements that you have in Manage that you create. So now we can see a list of all of the different agreement types that we have in our system that we represent contracts in Manage as, and we can see their gross profit. So now that we're looking at this, we're going to consider this to be, these should really be very similar to our service numbers because agreements really are services that we're providing our customers. So we want to see something around that 40 to 50% that we were talking about earlier. In this case, I can see that there are a couple of agreements that are really, really low gross margin, and some that are a lot higher. There might be some agreements that you use more as a way to bill additions, and you might expect to see higher percentages based on the way that you bill, whereas you might have other service contracts that are less profitable because that's where most of your time is entered. So you do need to kind of look at this and consider what goes into that contract before assuming that something with a lower gross margin isn't really valuable to your business. But in a simple sense, this is a great way to come and check in and see, oh, well, we really thought our block time recurring contracts were high value. We thought we were getting a lot out of those. Oftentimes we'll get into our bronze, silver, and gold managed services. What's the gross margin on those? What are we really getting out of those? And really, ideally on these different agreements, we're going to look for a gross margin at 45 to 50%, very similar to our services. If we want to drill into this deeper, so we just got a high level view of which of our contracts are the most profitable, what their gross margins are right now. It's likely we want to drill in a little bit deeper, and the best way to do that is through the agreement gross profit report. I'll get into 3 different ways that we can run this report that give us totally different information just based on what we're looking for. But my 2 favorite fields on this report are, of course, the gross margin field. So this is where we're going to look at all the different contract types and really try to pick out the ones that are much higher or much lower than that 45 to 50% range. Once we do that, we also have the ability to take a look at what I said we were going to look out for from the beginning, a training opportunity, any do not bill time. So any time that has been entered against this agreement, which has counted as a cost for us, but has not billed the customer or not taken away time from the agreement, we really want to spot that out because we don't want to see any do not bill time against our agreements, ideally. So the 3 ways that we can run this report. We can run this report completely unfiltered, and that'll give us an idea of what the profitability of these contracts are based on the different customers that have the contracts and the different contract types. So that's kind of going to be a very general view, general high level view. If we want to be a little bit more strategic with this report, there are two other ways that we can run it. One is by company. So this is a way that we can look at a single company. Maybe there is one company you work with, Eagle Construction, that has pretty much all of your service offerings. They have the different contracts that you offer. They have managed service, they have managed security, etc., cloud hosting, all those things. Well, you can run this report for just Eagle Construction and compare how profitable those different customers, those different contracts are for this one individual customer. Maybe you're really making all of the money within managed security, maybe it's managed services. It's just important to know for the next time you're trying to reestablish that contract. Another way that you can run it, which is my personal favorite, is by agreement type. Because what this does is it looks at a specific contract that you have, a service offering, whether it's managed services bronze or managed security, and it goes across all customers and you can compare the profitability. Is there a lot of variance in the profitability based on who you're selling this contract to? That can also give you some very important information when it comes time to renew agreements. Is it within your best interest to renew this contract with this customer? Is there a chance that this customer, because the gross margins are so high, is there the chance that this customer is going to wonder why they're paying this much every month for this service if they're not ever reaching out to you? So this can be a great way to catch that. Now, this is really great for our recurring services where maybe we charge a set amount per month based on users or devices, and we just want to know how much time we're putting into supporting those users and whether it's really worthwhile. Well, if we're considering agreements where they have a certain amount allotted, so for example, if they purchase 20 hours from us up front, or if they pay for these in advance, that's when we want to pull out the agreement reconciliation report. This helps us see how our customers are using the agreements, and it also helps us spot out some of those concerns, like maybe a customer isn't using an agreement that they already paid for. It may seem like it's good for us because we made this money and whether they use it or not, but they could start requesting that money all at one time. They could request a refund if they really never end up using it, or it could just make it more difficult for us to upsell them on different services if they're not finding value on what they currently have. So this particular report, agreement reconciliation, in a simple sense, it's great for questions from customers saying, hey, how many hours do I have left? You can print this report for them really quickly, either from the agreement, which is what I've done here, this reconciliation button, or from all reports or finance reports. You can print it from there as well. And it shows you, it's really just the, like a checkbook. It'll show you what they had. The allocation that's listed is what they received when the agreement was created, or each month when it resets, it'll allocate that amount, which in this case was 20 hours, and it'll show the balance. And then as time's entered, it deducts from that and updates the balance. So it's a really fast and easy way to explain to a customer what they've used so far and what they have left. It's a great report to print out and send to them, or just to answer simple questions. But I would be on the lookout for reports like this where that amount has been sitting for a while, because we definitely want to make sure that, especially if they get 20 hours every month, if that amount just continues building and building, or if that amount starts expiring, that's probably not a great experience for the customer. So we want to spot that out. It might be for a customer who's regularly not using up their hours, it might be a great idea to have the account manager reach out with suggestions for how they can better utilize your services so they can buy in, really get the most out of this relationship. Now, on the other hand, if it's someone who's constantly running out of hours, always asking how many do I have left, you're printing reports, you're checking for them, you're adding adjustments, that might be a really great opportunity to upsell them on managed services. It's likely that 20 hours a month is just not meeting their needs, and you might have a better gross margin and they might have a better experience if they were on a managed service contract. So this is just one more place where you can look. Moving on to projects. As I mentioned, for projects in this section, a lot of what we're looking at is how do you know if your projects are profitable, and also how do you anticipate the cost and revenue from projects more accurately over time. So I want to start off with a quick question, which is how do you know if your projects are profitable? Do you have a particular report that you use right now or some other metric? Thank you for your suggestions. It looks like some of us aren't entirely sure exactly where we're getting these numbers from. Sometimes we're exporting information to Excel to run those numbers. Thank you, Matthew. Some of us don't don't measure this currently. In others, it's hours against the project, so time entries that have been entered. Well, hopefully through these next couple of suggested reports, we'll find something that might be a little bit easier to use than exporting to Excel, or that might give you some additional information. And I did want to start off with the financial dashboard, simply because the financial dashboard will show us. Now, of course, you have to remember that it's only once it's been invoiced. Costs come in immediately and the invoice amount comes in later. So you might need to look a little bit later than you expect to see the results of your project, to see the actual profitability. But this is one of the best places to look up front. So within projects, it actually splits this out. I meant to stay on that a little bit longer, but it splits it out into the time, the product, and the expenses, and then anything miscellaneous in there. But mostly we're looking at time and products. We expect generally lower margins on hardware. Do we make up for it in services on these projects? Well, this is a great way for us to see if the numbers are adding up the way that we expect. We can drill into those gross margins. We can see the cost. We can see the amount invoiced. And something I'd also like to point out is that when you see an item underlined, that actually means you can drill in for more information. So this is a place where we can get into a little bit more detail if we're seeing numbers that we don't expect or don't like. Another another thing to consider with projects, this is oftentimes, as Matthew actually mentioned in one of his questions, we might see projects that are much longer term than our service work or our agreement work, which oftentimes agreements, it's month by month. But with projects, we might be working on that for months, quarters, years. It really depends on the nature of the project. One thing, especially with those long-term projects, that's really important to keep track of is, are we billing in a timely fashion? When we enter time on this project, how long does it take us to create an invoice? And is there a chance that we're letting time entries sit for too long without being billed? Now, the reason why I find this to be important is because we can run into invoicing issues when we send out time entries that were entered a long time ago. Because if a client has questions about it, if they want to know a little bit more detail on why that time entry is being billed a certain way or at a certain time, it's going to be really hard to provide the correct context if we didn't make excellent detailed notes on that entry. So first thing is, we definitely want our team member entering the accurate time. We want it to be approved quickly. We also want to have notes that explain exactly what happened. But even then, there might be more context that's needed if there comes an issue with invoicing. In that case, we definitely want to make sure that we're not letting entries sit for too long. So what this report does is it shows us, based on when the time entry was actually made, how long has it been sitting without being invoiced. And something that I wanted to call your attention to in the top is the time entry status. I think this is one of the most important fields when you're filling out the criteria for this report right before you print, because this field, you can have it sort by just any time entry that hasn't yet been placed on an invoice for projects and see where they line up if you have ones that have been waiting for 31 or more days, for example. You can also look at ones that are ready to bill, so it's been approved already. That's good to know. It's been approved, so we should be billing that really quickly. Those are the ones that we might want to really, we might expect to see more in the less than 31 days section. Something outside of that would be a little more alarming. We also have ones that have been submitted for review but not approved. That's another option we can do. That's if we were to select unapproved as the time entry status. And then we have unreleased. So it's been entered but not submitted even for review. So those are four very different reports based on whether this time has been entered but not sent for review, reviewed but not approved, reviewed and approved, or reviewed, approved, and on an invoice but not sent to the customer. So you can get a lot of different information from just this one report. Even as I was going through that, you might have thought of one of those situations that you really care about. Maybe it's, well, once it's been approved, we need to bill it as soon as possible. That would be the best way to run this report so that you can act on the information. And then we also have the project revenue variance report. Now, I like this report because what it does is it shows us the amount that we had listed in estimated revenue versus what we actually got in revenue from this project. So by running this report, maybe on a quarterly basis, I guess it depends on how many projects you're working through, you can start to see how different your expectations are from the reality of your project billing. And what that does is it really enables us, one, it enables us to spot out projects that went well outside of our expectations, because that might be something where a process wasn't followed, a team member did something that we wouldn't approve of and we need to retrain, or it could just mean that we're not really we're not realistic when we set out our expectations for projects. And if we're not being realistic, we're going to put our team in a rough situation where they don't have the time and they don't have the money to complete the services that we have promised to deliver. So for a couple of reasons, this report is really important, but oftentimes we're looking at it to see what did we list as our estimated revenue, what did we actually invoice, and what was the difference there. In this case, it's thousands of dollars, which we definitely don't want to see. But all in all, as we continue to use this report and continue to drill into why these numbers were so different, why we estimated so much, why we invoiced so little, it'll make us better at actually quoting accurately. And it'll get back to our sales team and we can ensure that we're setting better expectations. And I guess just before we move on, I was curious to know if you actually have estimated revenue for different project types, or if you consider that revenue and cost to be more case by case, meaning you couldn't say for this particular installation, we estimate this amount of revenue and this amount of cost. Okay, so it sounds like Terry is estimating cost and revenue on each project, and I'm assuming it seems pretty accurate. And then also some of us, like Donna, just says that the financial data isn't quite complete enough to have those estimations. Okay, interesting. Thank you for your input, Mitch. It looks like it's all for your company, it's all fixed fee projects and then a labor product. So estimated revenue of cost are just those products, and then the cost figures in when the project is created. And best of luck to your niece, Donna. That's extremely exciting. Playing for a gold medal tomorrow night. I'd be curious to know which sport. But thank you all so much for writing that in. So most of us expect 40% minimum margin. Gotcha. Very cool. Thank you all so much. Well, this type of report, if you're looking for, a 40% gross margin, unfortunately, this report doesn't specifically have that gross margin field, but that is something you can find within the financial dashboard. From here, you can see, though, if your estimates are really tracking, because it really does just take the invoice amount and the estimated revenue, and it just deducts. So you can see the exact number in dollars of how far off that estimate was, for better or for worse. And I just find that so important because the amount that we've estimated in dollars is time. It's team member time. And if we're not accurate in the amount that we expect it to cost, we can't be accurate in the amount that we schedule our team to work on it. So it all kind of works together. Okay, and yes, two updates. One, ice hockey, extremely exciting. Being in Tampa, I'm a huge fan of ice hockey, so that's very cool. Thanks for sharing, Donna. And then yes, this is being recorded. This will be recorded and it'll be on our video library. Since you registered for the event, you should be getting a link to the recording afterwards, but in maybe a week or so usually, we have them posted and available in the video library. But if you have any issues finding this webinar or another webinar, you can email education@connectwise.com and we'd be more than happy to help you out. So moving on to the company side, we've looked at labor in a more general sense. We've dug into our agreements, those different contracts, how we see what's profitable, our projects, project work, are we estimating the correct amount of time? Are we seeing the gross margins we expect based on what we intend for service and hardware? Now we're moving on to companies, and this is really our relationships with the different customers we work with. But we're going to look at this in kind of a higher level view, not just their agreements, but we want to look at their down payments, what they've paid us and they're waiting for us to use, and also their overall profitability, which can be kind of the health of our relationship with them. So first thing I wanted to ask is, how do you currently keep track of down payments and late payments? Do you have a process for this? Or do you occasionally run into a situation where you realize you have a down payment that you haven't used because the customer calls up? They're a little frustrated they keep getting bills. Okay, so Connect Booster. Donna, you find Connect Booster to be extremely helpful for keeping track of down payments and late payments. Very cool. Oh, and some of us haven't. Terry has not used down payments. Okay, fair, fair. We find down payments are most commonly used. You can associate down payments with many records, or you can just have a payment in advance. But we find that they're most commonly used for project work, especially if we wanted to bill for hardware in advance. I sometimes just recommend creating an invoice from a sales order for hardware, but you can alternatively create a down payment if you want it to be a very specific amount, and the customer needs to pay that in advance before you order the hardware. That's pretty common. One other use of a down payment is for contract work or sorry, for agreements where maybe you've had issues collecting payment in the past. So you've agreed to continue working with this customer, but maybe you require payment up front. So you can do that in a couple of different ways, but down payments are a way to accomplish that. And I'll get into two different ways to set up down payments just briefly, but I wanted to show my recommendation. We have a pretty nice report for open down payments that gives you a lot of good information. But really, when you're thinking about these, it's who's already paid you in advance for services and that money hasn't been used. I wonder, I would be curious to know how long you're comfortable having money sitting in deferred revenue. Maybe it doesn't matter too much to you, but does your company have any sort of set time frame where we really want to move through that money that's been sitting in our deferred revenue account and pull it over into revenue? Also, are the amounts restricted? This is one of the ways to create down payments. I could create a down payment in Manage, and the next time a time entry flows through to invoicing, it's going to pull from that down payment amount and it's going to cover that time. That may be exactly what you want, or you might have been wanting that down payment to only be used for project work that's not going to be billed until a month from now. Well, that's why you would restrict down payment to a specific project. That way those other time entries agreements wouldn't pull from that. So you can have restricted down payments or unrestricted ones that can be used for anything. And then lastly, I like this report because it's a nice way to look at your accounting package and look at Manage and make sure deferred revenue is matching up. Because if it's not matching up in Manage, it's more likely that it's accurate in your accounting package, but Manage is what your team members have access to, and it's where you make decisions and have much more high-level reporting on not just finance, but other metrics in your business. So we want that to be accurate. When we run this open down payment amounts report, we can see the different down payments that we have based on the company that they're for. This first example up here for Advantage Accounting, they have a down payment for $5,000 that they paid, and it's been restricted. And that means that we selected this project record. Could be a sales order, could be a ticket, could be an agreement, but it was restricted to the specific project. No amount's going to be deducted from that $5,000 unless it's being billed through that project. Now, as an alternative, or the other side of that, is we have an unrestricted down payment here for Eagle Construction. It was $10,000, wasn't restricted to anything. So when we had project work come through, $2,000 plus went out of that down payment, and the invoice has, or the balance has been updated. So they no longer have $10,000, but they do have a significant amount of money that can be used for anything. This is also a great place to double check and make sure that items that should be restricted are, and ones that shouldn't be restricted aren't, because if that was created at one point, you might run into a question of, why isn't my down payment being used, or why weren't they billed for the specific amount of time they were supposed to be? You can really quickly check in here, make sure that all of your down payments are restricted if that's your policy, or none are. Okay, so one question came through from Donna. I might need a little more background on this, but would you suggest a down payment over a dollar amount one-time agreement? Well, when you say dollar amount one-time agreement, I think you mean entering into the billing amount field on an agreement. If that's correct, we really don't recommend using that field. We like to bill agreements by additions, and now you can always throw on an addition for $5,000 and have that bill, but sometimes a down payment is just a cleaner way to handle that, because as time flows through the company, it's not going to go through an agreement that's an agreement shouldn't really exist if it's not representing a contract. So that's I guess probably a simpler way of saying that. If you want them to prepay for services, it should be a down payment, because down payments by their nature move over into a deferred revenue account in your accounting package, which I think in accounting terminology is the appropriate way to account for that revenue until it's actually been used. Then it moves into actual revenue. I also see another question. How do we get rid of the words down payment invoice? I'm not sure what you mean. Would you be willing to clarify what you mean, Lisa? Where are you seeing those words? Or do you mean just because it's been listed as one word and it's supposed to be two in some areas? That might be something that you can change on an invoice template. Okay, on the invoice. If you're seeing down payment listed as one word on the invoice template, that might actually be just because that's how it's still listed in the application, in which case, if you can't change it on the template, I'm not sure if there's another way to go in and edit it aside from using maybe the portal template instead, or a custom template. Oh, you don't want the words on there at all. I might need to dig into that a little bit further. I'll make a note and look into that for you. Oh, and then how do you send a bill for a down payment? Well, that's actually something with down payments that can be a little bit tricky, is that when you create a down payment in Manage, you send out the invoice as you would send out any other invoice. So you still print it and email it to the customer or print it and send it manually to the customer. They would pay that invoice and they'd have that amount in Manage to use. So when you're creating a down payment invoice, you still need to send it to them because likely they need notification that they should pay it, they need an invoice number, etc. If it was part of your contract originally, part of your quote, they might already have the information they need to make the payment. And in that case, if they were to send you a check, for example, you would just need to create the invoice so that you could show and manage that they had that bank of money, that bank of time and hours. Okay, one more thing I'm going to see if I can get through more of these slides real quick because it looks like I'm running a little long. But we have AR aging detail was something I wanted to bring up. This is going to be very similar to our project billing report that we looked at, where we just want to make sure those entries are being billed quickly, especially if they've been approved. We probably don't want them sitting for too long before we send out the invoice. Well, AR aging detail looks at actual invoices. So when we look at this report, this isn't a screenshot of the report, but I was trying to mix up the visual a little bit. We'd see the number of invoices for customers that were 1 to 30 days overdue. We could see the ones 31 to 60 days overdue, 61 to 90 days overdue, and greater than 90 days overdue. This is going to be a great place to look to try and ensure that, of course, we expect to see somewhat of a funnel. We would not want to see a ton listed in 90 days overdue. But the first thing we'll do looking at this report, or that you might do, is to dig into those items that have been sitting here for a long time and are very overdue. We definitely want to clear those out, either by getting them paid or closing them out, or maybe there was a payment made that wasn't linked in Manage. Well, once we clear that out, we'll have better information to work with. Then we can keep tracking this to make sure that our customers are timely with their payments. This could really just be a miscommunication. They may not know that we have a really easy way to pay in the customer portal now. They might have misplaced this email and they just don't know that they're overdue. It also gives us a really great chance to double check and make sure that the companies we expect to see as overdue are. So if we have a company that we've worked with for a long time and we know they're very timely on paying their bills, and we see them in like a 31 or 60 days overdue, that might honestly be a mistake. We can go back and look at that invoice, make sure the correct billing terms are selected, which that can be hugely important. We can have a customer that we normally give them 60 days to pay. Maybe they've been with us for a really long time and we just have this longer time frame for them specifically. Well, if they accidentally had an agreement renewed and created with due upon receipt as the billing terms, they're going to look overdue because billing terms and invoice date are used to calculate our late payment date. So if we say for one customer, your invoice is due in 30 days, and to another, it's due upon receipt, their 30 days overdue are very different dates or very different time frames for them. So that's just something to keep in mind. A great way to really get a higher level or a bird's eye view on overdue invoices that we might not see if we're simply just getting emails from workflow rules saying, hey, this person's overdue, this person needs to go to collections. Here we can look at all of it and really see what's going on. Now, how do you identify your most profitable relationships? I probably won't sit on this slide for too long, but I would love it if you would enter in the ways that you do this. Are there certain reports you run? Are there certain metrics? Is there something that doesn't have anything to do with metrics? Maybe just someone who refers a ton of business to you. All of those can be considered your most profitable relationships. But as you likely know, acquiring new customers is generally much more expensive than retaining the good ones. So it's important to know who your most profitable customers are so that you can really work closely with them when their contracts are up and make sure that they're happy. One way to do this is going to be through the gross profit by company report. So on the gross profit by company report, we're not looking at our agreement time, we're looking at really everything else. But what this allows us to do is see, based on the time entries that are entered, really how are we doing with this customer? Do we have a good gross margin on our time working with them, or are they possibly a drain on our resources? One way that a company might end up being a drain is if they consistently call in and argue invoices and convince members of your finance team or service team to move time to non-billable. That can end up driving down your gross margin. But from this report, we're looking company by company, and we can zoom in and see let's see someone who has a really wonderful gross margin. I mean, this actually looks a little high to me, but we have one company with 72% gross margin. We definitely want to make sure that we're keeping them happy. We also want to make sure that this isn't an artificial 72%, that time is being entered, that we're billing correctly, and that they're actually using our services. If they haven't entered a single ticket in the past couple of months, I would consider that to be a bad sign. We definitely want to have an active relationship with them. Now, if we're having quarterly meetups and everything is going really well and we're meeting their needs proactively, that might be a different story, but we want to make sure that's definitely the case before we risk losing this client who really helps out our bottom line. And then another one, we might see, the Pawnee Parks Department not going so well. We have a 32% gross margin. This customer may actually pay us a lot of money. They may pay a lot of invoices, but if they're requiring so much time from our team, if they're insisting that certain things are non-billable, or if they're simply just entering a ton of time entries on their tickets, it might not be that profitable of a relationship. Now, this could be another place. I would never recommend making a decision like firing a client based off of a single managed report, but this might be something to look out for. Maybe look for other metrics on this company. Does your team enjoy working with them? Are they do they send in any excellent like referrals? Are they a strategic partner for you? There may be tons of reasons why this gross margin would not be concerning, but it might be a training opportunity, or it might be a sign that it's not a good idea to renew this contract. Oh, that's very cool. So ones that are willing to implement recommendations, or maybe you might not have that much flexibility with government accounts. You never know. Another, let me see. So that is our gross profit by company report, and we can. It's also a great way to just see if our numbers are accurate. If we have a lot of variance in gross profit for these different customers, and they have very similar service contracts with us, it might be a good idea to look into why those are so different. Is it the team members they're working with, type of requests they submit, that sort of thing. If they fight you on security, they move down on the list. Fair enough. Fair enough. Now, one thing that we can do with this is, I don't want to just focus on the negative with gross profit. One thing we might want to do is really find those customers that not only are advocates for us in the community, but also lend to us having a healthy bottom line, and spread awareness in our team. Make sure that our team members know how to interact with this team, or how to interact with this company, how to work with them best. And one way we can do that is by company types. We have company type notifications like VIP client, where I can enter in a service alert. Now, all a service alert does is it doesn't pop up on the screen like a company status notification, but it shows up in a nice banner on the top that's very hard to ignore. And it'll say something like VIP client. When a team member opens up a ticket that sees this, it'll catch their attention and they can drill down and see just a little more information. This is a super generic example. Please handle with care. Reach out to the strategic account manager if you have any questions. But even just letting them know that this is a customer that's been very good to us is very important to us. Obviously, all of our customers are important, but this just helps them know who to go to if they have any questions. We do something very similar actually for onboarding to help teams work with them better, because obviously we want to be patient with every customer, but there might be a different level of patience required for a customer that just finished onboarding. So we might throw in a notice about this, like new 30 days client, we need to help them work with us better. But speaking of onboarding, that's another place where we can't make too many assumptions with profitability. You might not have been shocked to see low profitability on a customer that was just onboarded. They might have a lot more questions. I know more and more our partners are starting to bill for onboarding as a project, as a service, but I feel like even a couple years ago that was not very common. So if you're not currently billing for onboarding, you may be incurring a lot of costs up front and seeing your gross margins looking pretty weak, at least for the start of that relationship. Well, company profitability trending, it can show you based on the quarter, the last possible months, how the gross margin has changed for that company. So we run this, and I guess I moved past that kind of quickly, but we're looking at Acme attorneys. We have March, May, July, August, etc. And we can see how the gross margins change, and we'd want to see it trending upward, even if it did start pretty low. So this is just another way to not make decisions just based off of one report, but kind of look at the larger picture. So at this point, we don't have too much time left, but I did want to open the floor for any last minute questions. I think there were a couple that were asked that I did get a good few questions entered. So if I missed yours, please don't hesitate to re-enter. If it was really important to you, I'll try to get to it, but I am skimming through to see if there are anything that I missed. Oh, where do you put the note for onboarding or VIP? I will show you. So this is going to be in the setup tables. Boom, boom, boom. Company type. Within company types, you have the ability to turn on service alerts. The VIP client was the one that I used as an example, but new client first 30 days was my onboarding example. In here, we've turned on this type to say it's in their first months of service, please reach out to the AM. We might have another note like, please remind them to go to the portal if maybe they've been a phone service client just in their first couple of days. But this service alert won't do anything until this company type is applied to the company record. So that's when we get into our company screen and apply that type. So in Acme, for example, and this is different than a company status because our company status is locked down because it has to do with financial standing. So you'd have to go to the company finance screen to actually change that. But here we can select from our different types. VIP would have that status notification show up on all their tickets once I click this. Same with not a client first 30 days. As soon as I save this, any of their service tickets should have that banner show up. Yeah, so now it's at the very top. Something else I wanted to call out just while we're going through questions is that if you're ever in a report, one of the most confusing things can be the number of fields that are showing up as available. Don't forget that you can always click the eye icon to get into our documentation for that report, which goes through the calculations. It shows an example and a business case. So it can make it a lot easier for you once you're looking through these reports to find the right ones. And once again, that's write and manage that little eye icon. And then just before we wrap up, I know we're running on time, running a little late on time. Please, if there were questions that I wasn't able to get to, please feel free to email education@connectwise.com and our coordinator can funnel them to me and I'd be happy to reach back out. But that was, Donna, that was the company type setup table that I was looking at and the company screen. So you create the type and then you apply it to the company. But be sure, just as you're going through this, be sure to monitor effective rates and coach your team. Just make sure that it's what you expect because you don't want to end up with your team giving away too much time or not asking for help when they need it. Also, your agreements are likely critical to your business, so ensure they're profitable. And by used well, I mean that they're being used. If you give someone a bank of hours and they're not using them, if you have a month-to-month contract and they haven't entered a ticket for months, reach out, make sure they're actually getting the most out of the services you offer so they continue to see value and they can grow their business by being more successful. Also, project variance. It lets you see if your estimates are accurate so you can continue to quote more accurately and really set up your team for success. Also, bill for time as soon as it's been approved just to make sure you don't run into any billing headaches later by any misunderstandings. And then also take the time to discover who your most and least profitable customers are. That information can help you make decisions on who to upsell, who you need to spend more time working with, and who might not be the best fit for your company moving forward. If you're kind of strapped for time and resources, you might just want to work with the best customers. So thank you all so much for joining. I'm sorry I wasn't able to get to all of your questions, but this webinar will be posted on our video library within the next couple of days. And feel free to reach out to me either through education@connectwise.com or otherwise, and I would be happy to follow up with you on any of these questions. But thank you all so much for your time. I'll continue to go through these questions and try to answer in the chat, but I really appreciate it and have a great rest of your day.